Welcome to The Explainer. Right now, in May 2026, we're watching one of the absolutely most explosive commodity market moves of the decade. I'm talking about the massive breakout in silver. But look, this isn't just your standard supply and demand story. What we've got here is a really rare convergence. It's this moment where deep structural constraints in the physical metal are literally colliding head-on with an accelerating tech boom, and on top of that, major shifts in global monetary policy. So today, we're going to unpack the entire anatomy of this perfect market storm and use the hard data to figure out exactly why this is happening. Okay, let's quickly map out our game plan. We'll kick things off with the 2026 breakout itself, then dig into this massive 6-year supply deficit. After that, we'll look at the sheer industrial appetite coming from AI and EVs, map out the macroeconomic triggers like the Fed and geopolitics, and finally, we'll break down exactly where institutional price projections are heading next. All right, let's jump straight into part 1, the 2026 Silver Breakout. Over the past year alone, silver has completely rocketed up by a staggering 161.85%. It smashed right past that key $85 resistance level, hitting $86.27 an ounce. I mean, it is absolutely lapping gold's performance right now. We are officially in breakout mode, fueled by incredibly heavy buying and serious volatility. But to really get why the price is moving with such, ferocity, we have to take a step back and understand what silver actually is in today's economy. Think of physical silver as a dual-engine commodity. On one side, sure, it's a precious metal. It's that classic, safe haven monetary asset that investors naturally flock to when inflation bites or geopolitical stress ramps up. But on the flip side, it is an absolutely indispensable high-performance industrial metal with unmatched electrical conductivity. So when you combine that traditional monetary appeal with its critical role in modern tech and manufacturing, you get this incredibly unique market dynamic. You've basically got two massive forces driving the price up at the exact same time. Moving on to part 2, the 6-year supply deficit. Okay, this is wild. We are now entering our 6th consecutive year of global supply deficits. Year after year, according to the World Silver Survey, global demand has outpaced total supply. And for 2026, the projected deficit is peaking at a massive 46.3 million ounces. In fact, since 2021, the market has drained roughly 762 million ounces from above-ground inventories. Let that sink in for a second. We are literally consuming way more silver than we pull out of the ground, and it's been happening for over half a decade. And here's the kicker. The COMEX registered stocks, which is basically the freely available silver sitting in Newark warehouses ready to be delivered, have plummeted by 75% since 2020. We're talking about a drop from around 346 million ounces down to just about 88 million. Now, why does this matter so much? Well, above-ground inventory acts as the market's shock absorber. When you have high inventory, the market can easily absorb sudden demand spikes without prices going totally crazy. But with a 75% drop, that shock absorber is essentially gone. This is exactly why the price is so highly volatile right now and reacting violently to any new demand. Now you're probably wondering, hey, if the price is this high, why don't we just mine more silver? It's a fair question, but the structural reality here is pretty complex. First off, 70 to 80% of all silver is actually mined as a byproduct of extracting completely different metals, like copper, lead, and zinc. So miners can't just flip a switch and ramp up silver production just because the silver price is booming. Second, finding and building a brand new mine takes 5 to 10 years. So these high prices today won't actually bring new supply online until well into the 2030s. And finally, unlike an old silver necklace, 90% of the silver used in tiny modern electronics is practically impossible to recover and recycle. High prices just cannot instantly fix this physical squeeze.
Let's look at part 3, AI, EVs, and solar demand.
Let's talk about the sheer industrial appetite. Back in 2024, total industrial consumption hit a mind-blowing 680.5 million ounces. Here's how that breaks down. 310 million ounces went purely into electronics. We're talking high-performance connectors for AI data centers and the advanced semiconductor sector. They absolutely rely on silver's thermal and electrical properties. Then you've got 95 million ounces going into automotive, specifically power electronics and battery management systems for EVs. These next-gen technologies are fundamentally driving consumption. And the thing is, you just can't engineer silver out of them without sacrificing performance. And then there's the solar sector, which consumed 140 million ounces. Now, you might have read that global solar installations are absolutely skyrocketing everywhere. Yet, weirdly enough, projected silver demand for solar in 2026 is actually dropping by 19%. How does that even make sense? Well, it comes down to a really fascinating manufacturing trend called thrifting. See, because silver paste makes up roughly 10 to 20% of a solar cell's entire cost, these soaring silver prices force manufacturers to figure out how to use less silver per panel. So even as the total solar capacity grows, the amount of silver needed per unit actually shrinks. It's a brilliant adaptation. But here's the thing. Even with all that thrifting, the relentless industrial demand from AI and EVs continues to keep the overall market in a very deep deficit.
All right, part 4, the Fed and geopolitics.
To really grasp how macro events are impacting silver right now, we have to talk about the gold to silver ratio. It recently compressed dramatically down to 55.46. That means it takes about 55 ounces of silver to buy just 1 ounce of gold. This comparison is super important. Gold reacts primarily to fear, safe haven demand, and monetary stress. But silver reacts to all of that, plus industrial manufacturing demand. When global geopolitical events signal that factories are going to be busy and supply chains will stay open, silver gets a massive boost that gold simply doesn't. And that explains exactly why silver has been outperforming so strongly lately. And we have 3 specific upcoming events acting as major accelerants right now. First up, the May 6th Middle East peace negotiations surrounding the U.S.-Iran ceasefire. Easing tensions there directly impacts both inflation and safe haven dynamics. Next, we have the highly anticipated May 13th to 15th Trump-Xi summit over in Beijing. Remember, roughly 60% of silver demand is industrial, and a huge chunk of that flows right through U.S.-China supply chains for tech and solar. Any sort of stabilization in trade is a direct signal for a boost in industrial silver consumption. Finally, we've got the mid-June Fed meeting with Kevin Warsh. The entire market is watching closely for rate cuts. Because silver doesn't pay a yield, lower interest rates reduce the opportunity cost of holding it, which drives massive investment demand. So you literally have geopolitics, global trade, and monetary policy all aligning perfectly to push demand higher. Which brings us to our final section, Part 5, Where Will Prices Go? As you'd expect, there is a massive spread in institutional forecasts right now. JP Morgan's base case sits somewhat conservatively between $85 and $100 an ounce. That assumes gradual monetary loosening and persistent but stable deficits. But then, consider the tail bull case from Bank of America. They are modeling an explosive range from $135 all the way up to $309 an ounce. I mean, wow. This massive spread exists because these institutions are grappling with a market that literally has no shock absorbers left. If AI and EV demand accelerates even slightly faster than expected, and the Fed cuts rates aggressively, the upside volatility could be genuinely historic. So all of this really leads us to one incredibly provocative question. Are we entering a 1970s-style supercycle? Back in the 70s, a Federal Reserve pivoting on rates, combined with severe structural supply deficits, led to absolutely legendary precious metal breakouts. Fast forward to today, we've got 6 consecutive years of supply shortfalls, a drained COMEX, the relentless tech demands of AI and EVs, and a rapidly shifting global monetary landscape. We are witnessing the ultimate perfect storm. The foundation is absolutely set. The only question now is just how high this storm will push the market. Thanks for joining me on this explainer, and definitely keep a close eye on those inventory numbers.